It's another time with the enthusiastic tutor, tutorial as well. And in today's class, we're going to be talking about the financial and the real market. And it's the same course, BFN. We started, I think, this second class. I'm not mistaken, our course. And we'll be taking the financial and real market tonight. It has been said. Let's just straight into it. But just before then, on the comment section, set mindset. It's good to have you. It's blessing. It's good to have you aboard. Let's just go straight into it. Okay. So we have BFN209. Excuse me, pardon for that. BFN209. And we're talking about the financial and real asset markets. Okay, there are basically two types or two kinds of markets. Okay, kinds of markets. We have the financial, okay, and real assets markets. Real assets, it could be real market anyway. Okay, so the real market is said to be the market for physical or tangible assets. So I said real market or real assets market. Okay, so speaking of the real markets or the real assets markets, we have, it's a market that real markets are for physical, okay, or tangible assets. Physical or tangible assets such as plant, machine, office, building, weight, gold. All right, anything that you can get that is tangible and can be classified as an asset from any market, such market is referred to as the real or asset market. The market whereby you get assets, you purchase assets from. Okay, purchase assets from. So we have it as for physical or tangible. Or tangible, they are for physical or tangible assets. So we have such as plants, we have machineries, okay, such as plants, machinery, all right, buildings and etc. This should be machinery, not machinery. And we have building. So we have that as that. Now, the intangible real assets, speaking of intangible real assets, we have the likes of patents, technical know-how, and copyrights. Okay, intangible, all right, real assets, we have the likes of patents, okay, that's patents. We also have the likes of copyrights and technical know-how. When we say something about copyright, you don't get to use some other person's work without their go ahead or without their content. You will be flagged for copyright. Okay, so we have that as that. Now let's continue. Now, speaking of the financial markets trades of financial assets. the trade of financial, okay, the trade of financial assets. The trade of financial assets. Okay, now these assets promises future benefits in form of cash. All right, cash payments such as, if applicable, to bonds, certificates of deposit, and treasury bills. Now, when we say financial market, this is the market whereby financial assets are traded. Okay, financial assets are traded. All right, and there are benefits that if such assets are converted, it comes with cash benefits. Okay, are we together? Okay, so now speaking of these financial assets, we have the likes of bonds, okay, bank deposits. We have the likes of bonds, we have bank deposits, likes of bonds, bank deposits. We have the likes of stocks, okay, mutual funds, cash. All right, so we have that as that. Okay, mutual funds, we have the likes of cash. All these are called financial assets, whereby if you claim ownership to it, for owning them, good evening, Miss Oluwa Shei, came late. It's great to have you on board. If you have them, all right, you can claim ownership. If you can claim ownership to them, there are some benefits that are attached thereafter. Okay, so we have that as that. Now let's continue. Now it says here that a company can obtain what we call equity funds. Okay, equity funds by retaining earnings available for shareholders. Equity funds. We said something about equity. It's more like your capital. All right. Equity fund can be obtained by a company by what? Retaining earnings obtained a company, all right, by retaining earnings available from retaining earnings available for shareholders. Okay, equity funds can be obtained by a company by retaining the earnings available for shareholders. You know, usually shareholders get profits because they are part of the owner of the company. So if the company is making profit and if the company is about to realize profit, it is proper that they also get their own share of the profits. Okay, but what they say, if a company wants to get equity funds, okay, then they have to retain that earning that they want to share to the shareholders. Okay, so we have that as that. Please, as you join the stream, do well to smash the like button if you are yet to do that. Now it says here the equity funds we are talking about can also be referred to as retained earnings. All right, we call it internal equity. All right, undistributed profits. All right, undistributed profits. Thank you for that. Somebody just smash the like button. Awesome. All right, undistributed profits, also known as retained earnings. Yes, thank you very much. Now let's continue. Now, there's something called right shares. Awesome, another person just did. Now there's something called right shares, all right, public issue, and external finance. So let's quickly touch on these three before I erase the contents on the board for us to move to the next thing. Now, when we say right shares, financial I didn't get that. Mr. Luashi, are you trying to draw my attention to something? Okay. Financial markets. Yes, financial market. I think it's because you came late. Financial markets. So now, speaking of right shares, thank you, Miss Blessing. I forgot that you are even there. I would have just ignored that, knowing that you will attend to it. Now, speaking of right shares, after a company distributes all earnings to shareholders, it can reacquire new capital from the same source by issuing new shares. Okay? You know that the equity itself was gathered by the shareholders invested in the company. Now, we are being told that under right shares, if a company distributes all its earnings, okay, to the shareholders, it is their rights after all. It says that it can reacquire new capital from this same source by giving them new share. Okay? By giving the existing shareholder new share. And that's what we have at right shares. Now, we have something called public issue. Public issue says public issues now, you know that the right share you are only giving to existing shareholders. I think I should put that down. Now, existing shareholders. Here, existing shareholders are issued new shares. Issued new what? Shares. Existing shareholders are issued new shares. Now, but when we say public issue, under public issue, not issues actually, issue. Here, existing and new attracts new and existing shareholders, SH. Okay? Attract new and existing shareholders to contribute what? Equity capital. Okay? To contribute equity capital. Attract new and existing share to contribute equity capital. So we have creditors and lenders. These are external finance. They are not owners of the company. They provide money to enterprises as loan, which are debts. Those are external finances. All right, under external finances. Now there's something called bond / debenture. Here, bond slash debenture, we are talking about the certificates. These certificates states the amount of money lent by a bondholder to a company. A certificate stating the amount, all right, of money. This certificate is stating the amount of money lent by a bondholder. A bondholder, right, to the company. To the company. So we have that as that. Now, we want to take it up, all right, the notch a bit, and we're talking about some financial functions, okay? Now, financial function have been acknowledged as major in most organizations, okay? Financial function has been acknowledged as what? Major in most organizations. They are identified, all right? They are we together? Just a moment. Now, they are identified as raising funds, investing them in assets, and distributing the returns earned from assets to shareholders. Look at what it says. They are raising funds. All right? When these funds are being raised, okay, they are invested in assets, okay? Invested in what? Assets. Something that can generate money, multiply the money. Let's say, for example, an organization raised 20 million, invest it in landed properties, use it to build house, buy land, an estate project, and they started selling land or houses. Multiply the money by tenfold. So they take the money, the capital, all right, and they share the gain by the level of amount contributed, by the level of your bond or share. All right, it says the raise, money is being raised, fund is raised, then invested into assets. Okay, it's been invested into assets and distributing returns earned. Then after it's been invested into assets, then distributing the returns. Okay, distributing returns earned from assets earned from assets to shareholders. Okay, so that is what it means by financial function. Now you see why it is said that it is referred to as the major in most organizations, because it takes a lot of effort to first get people that can entrust you with their money. Okay, it takes a lot of effort to get people that can entrust you with their money. All right, now you get the money and invest it into assets. The guarantee that you get the money multiplied is not there. The guarantee that you might not even lose your money is not there. And you have to sit on this with series of brainstorming, all right, and ensuring that you are able to invest this money successfully. Okay, and after you have been able to invest this money, you also have to see to the fact that you have to distribute the returns that you have earned on this investment appropriately to shareholders. See why it is now called the major in most organizations. So now, this exercise is known as financing decision, investment decision, and dividends decision. Investment and dividends decision. So we have that is that. Now, in line of what we are saying, it says here that investment function is said to be investment decision. All right, investment decision that involve capital expenditure, which are referred to as capital budgeting decision. You know, when we talk about investment, we already talked about that here. Raise fund, invest it, then share back the dividends. Okay, but just expanding on it a little bit, it says there are two important aspects of investment decision. One, evaluate the prospective probability of new investment and the measurement of rates against prospective returns. Okay, how much can you gain if you invest in this project or assets? Number one. Secondly, what is the rate against the prospective, the chances of losing your money? Number two. Okay, note that, please. So now let's move forward a bit. Now there's something called investment dilemma or investor dilemma. Okay, this is a situation whereby an investor is between making decision on whether to invest in a project or not, considering the prospects or prospectus of a particular project. When we talk about prospect or prospectus, we're talking about how profitable the benefit of investing in this project is much and higher than the risk, considering the prospectus of a project. Investors dilemma. Okay, investors dilemma. Now, if the investor believes that there is some chance, however small, in the long run that he may earn a small return, he would extra effort that have obtained riskless investments. All right. So now, on the long run, investors will sit down to consider that can this investment grow on the long run. Instead of putting money or instead of investing in projects or assets that will give quick money with higher risk, an investor will sit and look, like I said, the prospectus, the prospects. Okay, the risk is low, but over time, on a long run investment, the return is guaranteed. Then the risk is high and investment is quick. This is what we call investor dilemma. In a situation whereby you need to make certain decision as an investor. So we have that as that. it is tied to risk. Investments is also tied to risk. Okay. Now it says here, it is very important. The word pertinent is used. It is very important to note that there can never be certainty, 100% assurance. There can never be certainty, all right, that the fruits, when reaped, would be commensurate with the costs of resources. Are we getting it? Expended in the production and marketing. Now, what are they saying here? As an investor, there is no 100% guarantee that the analysis of fruits, reaping of fruits, is used. Because definitely, as a farmer, when you plant, you are expected to reap your fruits. All right. Now, it says here that there is no certainty. It is pertinent to note that there is no certainty that the fruit reaped from your investment will be commensurate, will be the same thing, all right, will be commensurate to the labor, to the effort invested in the production, all right, and marketing of that investment. Therefore, there is always some chance that part of all your resources employed may prove to have been a waste, which is very true. All right. Now, it says that the risk that threatens the complete or partial loss of postponed fruits of effort can be classified under 4 main headings. So let me just erase this so that we can take something down on that. So these risks are physical risk, okay, economic and political risk. Okay, the physical, the technical, economic, and political risk. Now, speaking of the physical risk, what are we talking about? The physical risk can also be said to be physical and finance risk. Now, these are risks that some accidents may destroy or spoil some physical goods created by work financed. Example of this is a stock of food may go bad or be eaten up by insects. Okay, house may be destroyed by fire. A ship may wreck or sunk. Okay, dangers from natural disasters. Let's just categorize the physical risks as dangers from natural disasters. Natural disaster now could be fire outbreak, all right, it could be flood, it could be earthquake, it could be destruction, all right, that are physical. Okay, we have that as that. Now, speaking of the technical, let's just put it there as natural disaster. Natural disaster. All right. So now, the technical risk. These are those risks that arise from the fact that the producer's skills or that of the subordinate may not be up to expected planned level. You know, this is one thing that has to do with recruitment, having the right person in the right position. So if you are expecting that somebody you are employing now can work with little or no supervision, okay, with that, this is the result that the person should achieve in 6 months time. But unfortunately to you only expected too much from that person, or you assumed or you were deceived that this person could have delivered. but unfortunately, the person could not deliver. All right, this has to do with technical know-how. The person could not deliver based on the person is not up to the required standard or requirement of that particular project. So this is more of like technical know-how. So I'm going to use the abbreviation technical know-how, TKH. All right, if it's not up to the standard, so it's also a risk. Like I remember then when I was working in the cafeteria, we had this issue from the kitchen where the students usually complain consistently about the quality of our food. So we had to just, apart from the head chef, we had to just bring in someone who, no, we didn't actually bring in somebody. My boss actually had to stay back to ensure the quality control. There's something we had to open that department called quality control department. Some of them were coming at, at a point our standard has reduced this and that. So somebody was in charge of quality control, not even about the quantity, not even about consistent, but the quality. How consistent is the quality of our service? All right. So if unfortunately you had somebody in charge and you expected more, and unfortunately the person could not deliver, it's also a risk, and that is also the technical know-how. Okay, so we have the economic and finance risk. So this category of risk is usually the greatest and the closest related. All right, economic risk is said to be the greatest risk of all. They remain even though the physical object created suffer unexpected challenge. All right, so under this we have four main kinds of risk. Okay, under this we have four main kind of risk. One, two, three, four. So we have the risk of an inadequate supply. Risk of inadequate supply, risk of fall in demand, risk of fall in demand, and risk of failure of demand. And lastly, risk of potential purchaser denial. Now, speaking of natural disaster, speaking of technical know-how, all this will not even be there if you cannot produce. All right, or you produce, demand fall. Let's say you produce, but usually production normally you need to check, okay, the last time we produced 10,000 units, was it sold out? Was it a waste? Was some of it a waste? Was 10,000 units enough? Was it not enough? Was it a waste? All this thing has to be. Then what we use our dockets. Then, okay, considering that, okay, this particular type of food, when we produce that type of food, let's say for lunch, we are to expect 300 to 400 dockets. So on certain days whereby we now cook certain food, instead of 400 dockets, we're not getting 150 dockets. On that same day of the week, if you have to do the timetable or the roster for the food, we will need to consider on so date when we decide was our targeted met for that day. All these things have to be considered. Fall in demand. All right, there's a fall in demand. It's a big problem. because you produce, nobody to sell to. Risks of failure of demand, apart from even demand falling, that means there is still demand. What if the situation whereby there is no even demand at all right, or potential buyers are unable to purchase your product, all right, and this is very very, that's why I said to be the most dangerous of all, and it is very closest to finance. And lastly, for today's class, we have the political risk. These are risks of losses as the result of unforeseen intervention by government. All right, so these are unforeseen intervention by government. This really affects, companies that are into exporting, all right, foreign countries, whereby governments can discriminate on tariffs and a lot of things. So we have that as that. I think in today's class we'll have to just call it a wrap here for today, and in our next class we'll be taking our bearing from central role of the financial manager. I will just talk about the financial manager. Thank you very much, everyone. Please, for those of us that are yet to submit our notes, please let's keep them up to date and submit them to the appropriate quarters. And for those of us that we are still expectant joining the private class, let's do what, reach out to me on www.tutorial.com, that you may be added up to the private class. And there are a lot of things going down, a lot of resources we are going to be giving out to students during exam. All right, a lot are going down there. Thank you very much, everyone. Let's call it a wrap here for today, and I look forward to seeing you all in subsequent tutorials. You have a wonderful evening. Bye.